Yo, welcome to the liquidity recon, the only liquidity recon that you will ever need in your life. So let's get into it. What is liquidity? Liquidity is basically money in the market. Money in the market. How's money generated in the market? We know that traders like to trade something like this, right? And they'll put their stop loss here because they got in here. This is liquidity, right? When you have this doing this all becomes liquidity, right? Because here, people are putting their stop losses here, people are putting the stop losses here when price does this. So this becomes trend line liquidity. So what liquidity essentially is just where people put their stop losses. People can get in here and put their stop losses here. People can get in here and put their stop losses here. They can get in and put their stop losses here if they're looking for price to go down. Now, why is liquidity such a big thing? Why do you hear liquidity in trading so much? The reason why you hear liquidity so much is because the big players, when they want to enter the market, they need liquidity. Remember, liquidity is money in the market. So if the big players need liquidity to enter the market because their order is so big, we need to take some people out so we can gather their money, their stop losses, right? And then fill it in the big players. Hence why you see moves like this. We do this and then we do this. Taking this point here is the stop losses, money. A lot of traders put their stop losses here. When that gets triggered, especially if they're in a long, that becomes a sell. So they sell their position. And when you sell your positions, the big money are buying that position. And when they buy that position, hence why you see price go up. So this is why liquidity exists, is to basically fill in the big players. So now you might be thinking, how can I identify the liquidity that the big players want to take? How you identify it is liquidity can show up in multiple forms. So let's start with the first one, which is consolidation. Up, down, up, down, up. When price is like this, internally, where we're doing this, people are going to be putting the stop losses here, 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 here. Also, people are going to put in the stop losses here, 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 if they want price to go down. If they want price to go up, their stop losses are below. If they want price to go down, their stop losses are above. Remember this. That is one form of a liquidity pattern, you could say. Another one would be, as I went over already, trend line. Why is this? Because now it's giving people that we should be buying, because we're breaking highs and we're not breaking lows. So the lows are going to have liquidity there because people are looking to get in like this. 1, 2, 3. Do you get where I'm coming from? So when price does this, it's taking all their stop losses, which becomes a sell for the smart money to buy, to fill their orders in. Because remember, they can't just buy because there's not enough liquidity. There's not enough, you need enough fuel in the market for you to come in and buy something. Imagine you want to buy something from store. If there's not enough stock, you can't buy it, right? So in order for them to create stock, they have to cause people to sell the stock so they can buy the stock. Just understand it like that. So now another liquidity that a lot of people miss is when we have this one. This is what I call the smart money liquidity, right? Smart money trap, which is when we take out a low and we break a high, right? And it looks exactly like how you will trade, because now we have a main push, right? Because we have the main push, everyone's seeing it as this is extreme, and let's say if it had a decisional, we will mark the decisional, but in this case is an extreme. So people are seeing it as, okay, we're bullish, right? We're bullish. So when price comes back down and does something like this and taps into this point and then does this, they're now seeing it as, oh, higher time frame is bullish, we've tapped it, got the reaction as well, change the style delivery, so I should enter, right? But now the thing is, I call this the max liquidity, right? Which is when we have, let's say, a demand zone here, and price this point did not tap the demand zone on a higher time frame, which was a causational demand zone. So this becomes a SMT. The reason why it becomes an SMT because it hasn't tapped into the causational point. And if it hasn't tapped into it and it's done this move here is to basically fool people. It's to engineer liquidity. So when we come up and do this and price then does this and takes all of them out, let me show you where the liquidity lies. Liquidity lies here when we first tapped it, because you have those people that just buy like that, right? And they're looking for the next higher. You have other people that put their entries here on a lower time frame and they're looking to catch it on a bigger move, right? Same thing, they're all targeting this high. But this high, everyone knows we need to reach this high because why the market is bullish. However, where the market reacted from is not causation, it was correlation to what the market has already done, and it has not mitigated a causational point. So now what happens is we tap into this point and we fly higher, meeting this point that they originally wanted to reach. then this becomes liquidity. And you can also say that, oh look, even has trend line. Yes, but don't just use that to identify it. You're viewing it as this point did not touch this point here. Oh, this point here did not touch here, so it's invalid. It's invalid. It means that this point we still need to come tap it, because it's just the way the market moves. So this point could be a decisional, or it could be an extreme, because it's causational points which led to the breaker structure. If you need more context in terms of market structure, go and watch my videos or vote for it on the next PDF or the next data set. But right now we're talking about liquidity. So this is how liquidity is formed. Basically, we engineer it to give buyers, or to give a certain belief to traders. In this scenario is a buy belief. They want to buy and reach this high here. However, this point here has not been tapped yet. This is correlation. Because it's correlation, it becomes an SMT. And this is the one that normally you fall for and you end up taking losses from, because you haven't identified it properly. This one here. So be careful of this one. This one is easy to read because we get that on a lower time frame. As you saw it, we even had it here, this point here, right? Where we take out these lows. Oh, let me just remove this. Where we take out these lows and tap into this point here. It means nothing if the context is not correct. And the context is this point here. So this becomes the max liquidity because we're taking out everyone. We're fooling in buyers. And this could be reverse as well, where it's fooling in sellers, right? One sec. Yeah, this could be a thing as well where it's fooling in sellers, because this would be a supplier. We tap it and then we give the change of style delivery. Everyone's looking to get in here. They get toasted out. Everyone looking to get in here thinking, okay, maybe you haven't tapped the 50% of this point yet, and this point has only just done this, right? And they're looking for price to come do something like this into the 50% and then do it. So maybe they put their stop losses here. Is all liquidity. You have to understand this. When you understand this, you'll start taking less losses. So that is one major form of liquidity that does a lot of people. Cool. Okay, cool. So now you might be thinking, how can I use liquidity to take a trade? Now let me show you something. So imagine we have a main push, right? We established a main push. This is the main push. You know, let me do it like this. We establish a main push, right? Liquidity has been taken here, and we've established a main push. Let's do it like this. Green for main push. So this becomes main push, right? And then obviously this is where the main push finished. And let's say you're seeing this on the M15 or something. So on a lower time frame, you know, you can trade this. So when you see price coming down like this, 1, 2, right? And then let's say the 2, let me do it like this so we can have multiple trades in one. And I can show you what I mean. So let's say we've done this. Oh, all right, cool. So this, so we have a decisional now. In fact, let's do it like this. Perfect. And then we do something like this. Right? Cool. So we have a main push. We established this main push. This is bullish. This is bullish, right? And then we know that, okay, what caused this bullish move that changed the state here? This point here. What broke this point here? We can say that it was this point here, right? Cool. We can also say that this is where the extreme started. This is the origination point of the move that broke this. So this becomes extreme. Extreme. Where you at? Extreme. And then this becomes decisional, as we said. So now, what is liquidity? This is liquidity. Why? Because it did not lead to the break. It's a correlation. This started it. This is just a correlation. This actually broke it. So this becomes liquidity. So you see how we're building the liquidity before price even comes there. So cool. Liquidity. And then now, let's do a roadmap. What do we also see? We know that this was also liquidity, right? Because remember, after a main push, we know that we need to come back down. We need to come back down. So if that's the case, we know that we need to come back down. We can bounce off here or we could bounce off here. So now let's say price is now obviously taking this liquidity, and what would it have tapped into? The efficiency of the pullback being in the last high, I mean the last supply before we started retracing. So let's just put that there so you have some sort of context. There's another zone as well. So let's say we do this now. This portion here has taken liquidity and it has changed their delivery, right? What most people will see that as, let me see, I can't even do that. Let me do it like this. Okay, change the delivery. So yeah, most people have seen this and they're seeing it as, okay, this is supply, right? This is a supply. And they're looking for price to go and basically come back up and then trade it down to here, which could be a possibility. However, remember what I said, causational and liquidity. There's no liquidity up here. So what could happen is, if that is the case and we do tap into this and we go here, ideally you want to see something like this. and then this, and then break this, and then now you can get into a short, because why? Liquidity has been taken. Liquidity here has been generated, because remember the move is, oh sorry, and I'll explain to you. The move here is, we know that we've tapped into here, everyone knows that we're bearish, and we know that we're coming to retrace, so we know that we could either bounce off here or we could bounce off here. However, this point here you don't want to sell yet. The reason why is because it hasn't invalidated this point here. This point could have just done something like this. It came, tapped it, let's say here, all right, and then we could have done this move and then came into it 50% wise and then went up. Now where's the liquidity? The liquidity is, we fooled buyers, sorry, sellers, making them think we're bearish because we've broken this internal structure inside a causational zone. Liquidity, right? So at this point here, they got in here, well, people that wanted to buy here, when they got this, let's say a little change of state of delivery inside here candle wise, when they've seen the change of state of delivery, they're seeing it as causational zone, we've changed state of delivery, this we're likely to break, so they're looking to get in. So they'll get in like this, something like this, using candlestick confirmation, and they're looking for this high to be taken. Okay, cool. What do we also see here? We also see that, remember we said sweep, tap into an efficient pseudo pullback, which is a valid POI, and then we have a change of state of delivery. We know that we could start the retracement sequence. So a lot of people are thinking, okay, I can get in here as well. So what do? They see liquidity build, they get in, and they're looking for price to come to the extreme because they think the decision was going to fail, right? And then what happens? Price basically, okay, let me use this one. Price basically takes out the early buyers, and then we target the wrong sell. We target the sellers who are wrong. They got the narrative wrong. So now this is the liquidity of the early buyers, allowing the big money to get in more, to get their orders in. Because remember, SLs need to be taken. They need to be, because there's less stock, we have to force people to sell so we can buy. So we forced these guys to sell. Why? Because we've come and taken out their stop losses, and then as soon as we took it, we bought this, but as soon as they sold it, we bought it. So when we bought it, now we're buying with a big money, and then now we're targeting the people who are wrong of the context of what's going on, which is this is a causational zone. Until that is broken, we don't look for shorts to come to the extreme. Cool. This is one scenario. Another scenario would be, let me just remove this. Another scenario would be, let's say we break it and do this and come to this smart money, SMT. Now, what are people thinking? What are people thinking when they see this? So already we've taken out, obviously we've taken out these guys. These guys were liquidity. We've taken them out because they failed to break this point here and price came back down. So they're the early buyers, because remember, market structure says we're bullish. We've broken structure here. So everyone's looking to buy when we're coming into the demand zones. So they look to buy here, but obviously that's not where price is going to react, because maybe price wants to come deeper. We don't know whether it wants to come deeper or not. We can only see by confirmations. So now this point here, you don't want to be selling, you don't want to be buying, because you don't know that it's ready to go yet, which is to break this point here. We haven't done that yet. So when we've done this, when we've taken this point out, this is early sellers becoming liquidity for the big players to start buying that. Cool, we buy that now. But then now when we get here, we might have a little position here because not a lot of people bought here, because they could tell that maybe the decision was not qualified. So when we come down, we've taken their stop losses to fill in some big players, but it's not enough. So what do? Price comes and taps into the smart money trap. But remember, I already identified that this is liquidity. Why? Because there's a correlation to what actually broke this. It started here, this finished the job. So this means nothing. The reason it means nothing is because the objective of this has already been fulfilled, which was to break this, right? And it's done that. It failed to break this though. So this is what broke that. So this becomes the causational. This is correlation. This is causation. So when we come and do this now, and it always does this, I'll remove the supply and it'll take out the supply as well sometimes, and it'll come to the efficiency of the pullback. Remember, the efficiency of the pullback. When it does this now, where's the liquidity? Cool. So remember I said sellers, we've broken the signal, so they're looking to get in now. So they're looking to get in here. But sometimes they'll put their stop losses there. Some will put, let me just do it like this. Some will put their stop losses also here, right? And they're looking for price to come do this. Both of them are looking for price to come and do this. And we've taken them out. This becomes liquidity, right? If we look on the left, what do we see? Trend line liquidity. You see how it all lines up with the patterns when you understand what is actually happening behind it. So now look, this is trend line liquidity. Where is it? trend line liquidity. See how we've taken all of that and then we've come back into the zone where a new liquidity cycle could start, which is the efficiency of the pullback, because maybe the pullback is not done yet, and we can confirm that the pullback is not done yet because we've broken one causational zone. So we have to go to the next causational zone. This is correlation. So this is just giving a reaction to give more liquidity, because we know that the reason why it's doing this is because here holds a lot of weight and a lot of smart money want to buy right here like this. They want to buy right here like this, right? And because they want to buy right here like this, they need as much stock as possible so they can buy. If there's not enough stock, they can't buy, and they want it for cheaper as well. The only reason why they're going to have more stock when it's cheaper is because people get scared and they sell, hence why they have stop losses. So when the stop losses get triggered, more stock come into the market so the big money can buy and fill their positions. And when they fill the positions, ideally they want to feel it. They want to fill that position in the 50% zone, which is like here, anywhere below this 50% level. And look where these people who are going to trade this new main push, because it's taken out, look, it's taken out this sell cycle. But remember, this sell cycle is completed, so it's meant to take it out anyway. Look, sweep, push. So sweep, main push, mitigation, expansion, it's done. So now we do a new one, a new cycle starts, but the new cycle comes and takes out all of these guys because it's their liquidity. This is where stop losses are or people are placing their stop losses. So when we do that and take them out, we've now got their liquidity. Now look here like this. We've now got liquidity to now fuel the market down to do the last scary move, right? The last scary move to come down, which will entice more buyers to sell because they're scared now. It's like we've got all the way up here and we came back down, and the people who are getting in here, let me just do it like this, the people who might be getting in here with candle confirmations, right, to go and break this high, price comes close to their TP and it doesn't take them out. I mean, it doesn't take them out the trade for them to make profit. What we do is we come all the way back down and take them out, because they would have put their stop losses here or even here. Right, we come and take all of that out, and imagine, look how big this move is, and look how much conviction this move would have given people to buy. So imagine people are now, instead of risking 1%, they're probably risking 10%, because they think, yeah, the move is done, we're basically going to replicate this leg again. And this point probably had an inducement in it as well, like a lower time frame confirmation, like something like this, sweep, and then we pushed out, and it's seen that it hasn't been mitigated yet, hence why I had this massive move. But that massive move, remember, this is correlation. So because it's correlation, it needs to fool people in. When you know this, the fooling people in is what gets people to put a lot of money on or in the market. And that money, when they put it in the market, they're protected with a stop loss. And that stop loss is the liquidity that is going to allow us to take them out the market so we can buy their shares or buy their stock. And when we buy their stock, guess what? We're buying it with the smart monies, the smart money buyers. Hence why after this, you see price just rips all the way up like this. Why? Because we've done, this is max liquidity. Max liquidity. Why? Because look, sellers wanted to sell from here and they sold. We've taken out sellers, all sellers that were here, we've taken them out, and we've tapped into this point here, which is again a point of interest. And a point of interest I identify as a point in the market where a new liquidity cycle and a new market structure cycle could start. And guess what? We have that. We break it. But when we do this now, what do you think a lot of people are doing? A lot of people are seeing it as, okay, now we're bearish because we got into a sell, we got taken out, but now we've broken the point where price reached and didn't reach our TP and it's taking us out. So now let's get into sells again. So what do they do? Within this move here, you have lower time frame things like this going down. Right? Let me just remove this. Each one of these is stop losses. Why? Because now this move here, the move down, has confirmed to sellers that, oh, we're still bearish. So now when we've done this, they're looking to sell here. They'll look to sell here, they'll get taken out. They'll look to sell here, they'll get taken out. They'll look to sell here, they'll get taken out. They'll look to sell here, they'll get taken out. They'll look to sell here, they'll get taken out. What are we doing here? What are we doing here? The reason why price keeps going up is because, look, people are selling and a lot of people are buying. The smart monies are buying, right? They're buying. And then when we get here, the smart monies are selling. But ideally, the smart monies are selling to these guys here. They're selling to them. They're selling to them gradually. Not majorly, but they're selling to them. That's why when we get here, we have a bit of sell pressure because there's a lot of liquidity there. A lot of people are looking to get in on these supply zones here to sell down. So they enter again with a market, so with a stop loss. And when that gets triggered, guess what happens? If you get into a sell, and the market takes you out, remember, you're selling because you want price to go down. So when the market takes you out, it's buying. So it's buying you back into the market, pushing price higher. Think of it that way. hence why price keeps ripping. But now let me show you how this actually played out on German 40. The same thing, and it's basically how liquidity runs. One sec. So look, I'm just gonna do this quickly. Start a new one, and I'll bring it here so you see what I mean. Perfect. Oh, let me do on German 30. It's the same thing anyway. It's just I have less things on there. Yeah, perfect. This is exactly what the market done. Look, extreme causational, right? Causational point of interest, right? Causational point of interest. This is not causational. This point here, look, is even like a F. A lot of people will trade this and see this as, oh, we didn't mitigate that. Look, it's a flat bottom. Flat bottom. We've come and wicked it, meaning we've taken out. This will become liquidity because it's flat. It will become like a equal lows or something. We've swept that and we've taken out the sellers. Look, we've taken out the sellers here because this candle broke this low and broke the decisional. So we've taken out that candle here. A lot of sellers have been taken out, and they're thinking buy. A lot of sellers have turned bullish, and now they're looking to buy in these points here, and their stop losses get taken here, right? Their stop losses get taken right here as liquidity. And then what does it do? That trick, because it was such a big move, it triggers a lot of stop losses, a lot of big orders that want the price to keep going up, and they've lost a lot of big money. That big money that they've lost, or a lot of shares, they basically when your stop losses in a buy gets triggered, it turns into a sell. So now the sell, these smart money buyers are buying it. They're buying it, and they buy it right here. Hence why it's a wick and then wick. This is on the daily, and then look what happens. We just fly. We have a bit of movement here because why? A lot of sellers are trying to sell because they've seen that, oh, they were bullish here, they got taken out, now they're turning bearish. The bearish is this candle here. And what's happening? We tap it, we fail to break the low. Every single time we tap it and come down, buyers are buying. So you see how we fool them and we're still generating liquidity. Look, liquidity that we could target. You see what I mean? So that we've taken their liquidity, their stop losses, and we've changed their mind as well. Their mind is now, here they were bullish, now they're selling. And they're selling at their last, you call this a decisional because it's what broke this low here. So they're selling at their decisional, which is also causational. However, their context is wrong. So it becomes liquidity. And you see how we break above it. And when we break above it, a lot of people think, okay, cool, this is trend line, so I'm not going to sell yet. I'm going to sell at this point here, right? They're looking to sell at this point here. But remember, it's SMT, and we fly through that. This is more sellers turning buyers. I mean, more sellers in the market turning buyers in the market. Hence why we get the explosion. You see what I mean? And then we keep going, offloading the liquidity, offloading the buys that we took here, and now the cycle is done. So liquidity is basically how this cycle plays out. Sometimes it can be 1, 2, 3, 4, clean like that. Sometimes if the buys or the move is so strong, we need to generate liquidity. So we need to generate liquidity, and you know, when we're generating liquidity, it shows you that, you know what, this zone here, the causational zone, when we tap it after taking out the liquidity, there's going to be a lot of momentum for you to enter from and get a big move like this on a daily, on a 4H, on an hourly, on an M15. It all happens. Each candle, there's liquidity happening in there. As you can see, the low of a candle gets taken, something like this, we go for the high of that candle. The high of a candle gets taken. Wait, let me show you. A high of a candle gets taken, we come for the low. You see what it means? Look, but before that high of the candle got taken, that candle itself gave a certain belief. It changed, it broke this high. But then this candle took that high, that candle's high, and we came and took the candle's low. Liquidity. Here, a lot of buyers got involved. So they're looking to buy here. We come back down, take their liquidity. Here, a lot of sellers were selling here because we tapped into this point here. Look, we tapped into this point here. So a lot of sellers are looking to sell. Price doesn't move that much. We generate liquidity, fooling buyers saying that, oh, we're going up. Generating liquidity here for us to offload our positions when we get in. Look, price comes, it takes out this high where the sellers were looking to get in. Let me use it like this. Sellers were looking to get in like here with their stop losses here. Why? Because this broke the decisional, right? So now they're putting their stop losses here. Price comes, takes them out. When it takes them out, what does it do? It puts more of their shares on the market, and then the smart money sells that. They sell that at higher prices, and then smart money will buy at lower prices, and they'll go up. Understand that smart money, they just buy it in premium zones and in discount zones. They don't buy equilibrium. Equilibrium is where traders take losses. Like for example here, if you check this here, equilibrium will be the 50%. Look, you have a candle going up, people are trying to buy, they get taken out. People that buy in this point here, they're looking to put, because you know how people trade with Fibonacci's, they'll do this and put their stop losses here, buying a discount and looking to sell in a premium, but that discount you're buying on is equilibrium. So what does price do? It comes down, takes them out, exactly that, and then we go. The move that they wanted here, hence why you see this up candle, the move they wanted here, it doesn't happen there, it happens after we take them out, because they are liquidity. So when you understand this, you'll stop using Fibonacci's and stuff and start using solely liquidity like this, reading a market like this. Just 3 points of interest: decisional, extreme, and the efficiency of the pullback. These points here, after you've had your main push established, you need these 3 things here. Why? Because look, main push, you can get into a trade here, you can get into a trade here, you can get into a trade here if this doesn't meet the causational zone or it breaks one to come meet it. And then once we meet it, that's the mitigation, and you can trade it for the cycle to end. And that is liquidity summarized. I hope this helps you. If it does, react to the message in the channel, and follow me on all channels. I'm trying to reach a certain stage where I drop things like this on YouTube daily. So help me out so I can help you out. Peace.